In this video, we're going to learn two different things. One is how to solve for the present value of an ordinary annuity, and the second, how to do an amortization table that shows the passage of the loan over that period. So let's assume Jonas has purchased some piece of equipment, some great guitar and studio equipment, and he's agreed to pay the seller $8,000 at the end of each of the next 4 years, and at the end of the 4th year he will have been paid off. Well, from an accounting standpoint, Jonas is going to have to debit equipment and credit the amount that he's got in this loan. But according to accounting rules, we have to do this at the present value of the loan. So that is considered the cost of the studio equipment that he's buying. So first, let's find the present value of this ordinary annuity. So we know that the number of periods is 4. The rate is given to us at 10%. Present value is what we need to find out. The payment, $8,000 at the end of each year. I can put in type equal to 0, or I could leave it blank. The future value is 0 because at the end of the 4th year he does not owe any more money. In order to solve for the present value, I'm going to go in here, I'm going to click on my formulas and find my present value formula. I enter it as a negative. I'm going to leave these two blank, or I could enter zeros. So basically, the present value of this installment note that Jonas has taken out is $25,358.92. Basically, from an accounting standpoint, the studio equipment that he has just purchased, that's its value. So that's an important part of doing the accounting for it. The next thing we're going to do is actually do what's called an amortization table to show Jonas paying off this loan. So I'm going to extend my screen a little bit and add a few extra columns. Beginning CV stands for beginning carrying value. So the amount that he's officially borrowing, the present value of that amount is that. The payment, we know, is equal to $8,000. The interest expense for the first year, we're going to simply do the beginning carrying value, and we're going to multiply that by 10%. So every time he does an $8,000 payment, part of it is going to interest. Whatever's left over is going towards principal. So in order to find the amount that actually he's paying on principal in year 1, I'm going to take the amount of the payment, I'm going to subtract out the amount of the interest. So that's the amount that went towards the principal. So the ending carrying value, let's think about this. We started the year at $25,358. We made that payment. Part went to interest. Well, the rest went to principal. So our ending carrying value, what we still owe, is going to be the beginning carrying value. And we're going to subtract out our principal amount. And now we have our ending carrying value. So at the beginning of year 2, our ending carrying value from last year is our beginning of this year. The payment is still going to be $8,000, so I'm going to scroll that all the way down. Well, that didn't work. The reason that didn't work is that the column Q that referenced that cell there, it was referring back to column M next to payment. And when I tried to just click and drag it, it's looking for the cell underneath payment as a reference. And so what I've done instead is just done equals to the one above it in column Q, and then I've dragged. Okay. Now the interest expense, I have a formula in here, so all I'm going to do is drag this formula. It's going to take whatever's in this column, multiply it by 10%. So I'm going to go ahead and just drag the corner little tail there of the box, and notice it fills for that year but doesn't for this because there's no values in here. The principal amount, again, this is a formula. I'm just going to drag this down and it's going to automatically populate. The ending value, I'm going to do the same here. Okay, so what do we need to do is fix this one. So notice that little corner, that's all I'm doing is dragging that. So if I've done this correctly, what we see is that he pays $8,000 each year. The amount of interest is it's getting smaller and smaller. Why? Because the carrying value is getting smaller and smaller. you're going to pay less interest when you owe less principal, right? And so this is the kind of the beauty of time value of money, is that we can actually see that as this kind of passes, he'll be all paid off at the end of the 4th year. So that's how we do an amortization table for a loan installment. And so you'll see this again and again, but it'll help us at least get through number 4 on your homework. You'll have separately different numbers. This, if you want to read a little bit about this, you can go into chapter 14, and I think it's page 792. They'll have an example. But interesting stuff.